Back in June 2014, China had saved up nearly $4 trillion in cash. Just think about that for a second. That's more money than the entire economy of Germany, the world's fourth biggest country. But here's the crazy part, that wasn't even all of it. According to Brad Setzer, a financial expert at the Council on Foreign Relations, China had hidden another $3 trillion across their government-owned banks. They basically had $6 trillion sitting there ready to use, while America's biggest banks were gambling themselves into bankruptcy in 2008. Lehman Brothers was borrowing $44 for every $1 they actually had, and Bear Stearns collapsed with a 36-to-1 ratio. China was quietly building the biggest financial war chest the world has ever seen. This wasn't an accident. This was a plan that started decades ago, shaped by watching every time Western banks screwed up, and executed so perfectly that Wall Street never saw it coming. The question isn't if China beat the West at their own game. That's obvious. The real question is, how did they pull it off, and what does this mean for the economic system we all thought would last forever? This is the story of the greatest financial power move in modern history. To understand what China did, we need to go back to July 1944. That's when 44 countries met in Bretton Woods, New Hampshire, and created a new money system for the world. Every country tied their currency to the US dollar, and the dollar was tied to gold at $35 per ounce. This made America the center of world finance. For almost 30 years, this worked fine. But on August 15, 1971, President Nixon did something shocking. He stopped letting people trade dollars for gold. This changed everything. Now, the dollar wasn't backed by anything real. It was just backed by people's trust in the U.S. government. Economists call this America's exorbitant privilege. The U.S. could print money to pay its bills because everyone still wanted dollars. Other countries had to actually earn dollars by selling stuff to America, then hold on to those dollars as savings. This one-sided system controlled global finance for the next 50 years. But China studied this system closely and spotted the weak point. The whole thing only worked if everyone kept trusting US Treasury bonds. If that trust broke, or if someone created an alternative, the system could fall apart. China learned from watching others fail. They saw the Asian financial crisis of 1997 and 1998 destroy Thailand, Indonesia, South Korea, and Malaysia. Those countries didn't have enough savings when investors pulled their money out. The International Monetary Fund stepped in, but forced them to accept brutal conditions for help. Back then, China only had $140 billion saved. That crisis taught Beijing a critical lesson. In today's financial world, savings equal power. Without massive savings, you're at the mercy of Western banks and their rules. China's strategy became crystal clear around three ideas. First, save foreign currency on a scale never attempted before. Second, spread those savings across different places so nobody could see the full picture or pressure them. Third, use that money not to buy stuff, but as ammunition to build a whole new financial system that could rival the West. On December 11, 2001, China joined the World Trade Organization after 15 years of tough negotiation. This was the turning point. Joining the WTO gave China access to Western markets like never before. The results were incredible. According to Federal Reserve research, some Chinese exports grew by 220% between 2001 and 2007. China became the world's factory. But unlike other countries that export a lot, China didn't use its profit to buy foreign products or let its money become more valuable. Instead, China's central bank jumped into the currency markets big time. Here's how it worked. When Chinese companies earned dollars, euros, or yen, the central bank bought all that foreign money with freshly printed yuan, kept the yuan artificially cheap, making Chinese products even more competitive. But it also meant China was piling up foreign currency at a crazy speed. In 2000, before joining the WTO, China had about $165 billion saved. By the end of 2006, they had over $1 trillion. By 2013, they had $3.8 trillion. At the peak, in June 2014, China held just under $4 trillion more than any country ever. Now compare this to what Western banks were doing at the same time. Big investment banks took a completely different approach. They borrowed money to make bigger bets and bigger profits. In 1998, Bear Stearns was borrowing $35 for every $1 they had. By 2007, Bear Stearns had $395 in assets, but only $11.1 billion of their own money. That's borrowing $36 for every $1. Lehman Brothers was even worse. Some estimates say they were borrowing $44 for every $1 they actually had, but it wasn't just about borrowing too much. Western banks had completely changed how they did business. They weren't holding on to loans anymore. They'd create mortgages, package them into complicated securities, sell them to investors, and collect fees at every step. The derivatives market exploded into hundreds of trillions of dollars. Banks were all connected to each other in ways that even regulators didn't understand. When housing prices stopped going up in 2006, everything started cracking. In March 2008, Bear Stearns collapsed. JP Morgan bought them in a fire sale with $29 billion in guarantees from the Federal Reserve. 6 months later, on September 15, 2008, Lehman Brothers went bankrupt. It was the biggest bankruptcy in U.S. history. This triggered a global freeze in lending. Banks didn't know who would fail next, so they stopped lending to each other. The whole system was about to collapse. The U.S. government responded with emergency plans that seemed impossible just months before. The Troubled Asset Relief Program put up $700 billion to buy toxic assets and save failing banks. According to MIT Professor Deborah Lucas, the total direct cost of crisis bailouts reached about $498 billion. Or 3.5% of GDP in 2009. But other research tells a more dramatic story. According to Better Markets, the 6 biggest U.S. banks got about $8.2 trillion in bailouts through all kinds of emergency programs from the Federal Reserve and Treasury. While Western banks were collapsing and begging the government for help, China was watching and saving. In just the last 3 months of 2013, China's foreign reserves grew by $157 billion. This wasn't speculation or fancy financial tricks. This was China consistently selling more than they bought and turning those profits into strategic savings. The contrast couldn't be more obvious. But China didn't just save money. They built a whole parallel financial system designed to work independently from Western institutions. In 2007, China created the China Investment Corporation, a sovereign wealth fund that started with $200 billion. As of December 2024, according to their annual report, it now manages $1.57 trillion. This makes it one of the world's biggest sovereign wealth funds, investing in stocks, bonds, alternative assets, and real estate worldwide, but that's just what we can see. The State Administration of Foreign Exchange, called SAFE, manages China's official reserves. According to Brad Setzer's research from June 2023, SAFE and other government-owned entities hold about $3 trillion in additional foreign assets that don't show up in the official numbers reported by China's central bank. These shadow reserves are held through state-owned commercial banks, policy banks, and other financial institutions. This structure does two things. It hides the true size of China's financial power, and it spreads out the holdings so there's no single weak point. China has also been systematically buying up strategic commodities. According to multiple reports, China's central bank started buying gold again at the end of 2022 after 3 years of not buying any, adding 62 tons in November and December alone. But research from Kitco News and other analysts suggests China's off-the-books gold purchases are about 10 times higher than the official numbers. China now controls about 92% of the world's rare earth processing. According to the International Energy Agency, in October 2025, China announced new export controls on rare earth elements, a strategic move that shocked global supply chains for technology, defense, and renewable energy. Infrastructure investment became another weapon. China launched the Belt and Road Initiative in 2013. From 2013 to 2021, China provided $679 billion for infrastructure projects across over 140 countries, according to a Government Accountability Office report. In 2024 alone, Belt and Road deals reached a record $70.7 billion in construction contracts and about $51 billion in investments. The first half of 2025 saw even bigger numbers, $66.2 billion in construction contracts and $57.1 billion in investments. Compare this to World Bank infrastructure lending, and you see a fundamental shift in who finances growth in developing countries. In 2015, China created the Asian Infrastructure Investment Bank as a direct alternative to the Western-controlled World Bank and International Monetary Fund. The AIIB launched with 57 founding members. The United States notably refused to join. As of 2025, the AIIB has 106 member countries. China holds about 27% of voting shares, making it the largest shareholder. Research shows that in countries where both operate, the AIIB's presence reduced World Bank infrastructure projects by an average of 22%. Perhaps most strategically, China is developing the digital yuan, officially called the digital currency electronic payment system. China became the first major economy to launch a central bank digital currency. This isn't just about modernizing payments. A digital yuan integrated with China's cross-border payment system could provide an alternative to SWIFT, the U.S. dollar-dominated system that underpins international financial transactions. If China can convince trading partners to settle deals in digital yuan, it could gradually reduce the dollar's role as the world's reserve currency. Now consider China's position with U.S. Treasury bonds. As of early 2025, China holds about 761 in U.S. Treasuries, according to Treasury Department data, though other estimates, including Brad Setzer's research, suggest the true figure is closer to $2 trillion when you count holdings through offshore entities. This has led to talk about China weaponizing its Treasury holdings, dumping bonds to drive up U.S. interest rates and crash markets. But that analysis misses the point. China's real power isn't in dumping treasuries. It's in having saved enough that they don't need to buy more. China can run independent monetary policy, control currency markets, finance global infrastructure, and build alternative institutions, all without relying on Western banks or approval. This is financial independence on a scale never achieved before. The implications go far beyond balance sheets. We're watching the emergence of a multipolar financial system. For 70 years, the Bretton Woods framework and its dollar-centric successor defined how global finance worked. That monopoly is ending, not through a dramatic collapse but through slow erosion as alternatives appear. Think about what happens when developing countries need infrastructure funding. Previously, they had two choices: borrow from the World Bank with policy conditions attached, or borrow from private markets at high interest rates. Now they have a third option: Chinese financing through the Belt and Road Initiative or the AIIB. These loans often come with fewer political conditions but create different kinds of dependency through debt levels, and control of strategic assets. The dollar's role as reserve currency has given the United States enormous advantages. It means central banks have to hold dollars, creating automatic demand for treasury bonds, which keeps us borrowing costs low. It means American companies can do business globally without currency risk. It means the U.S. can impose financial sanctions that cut countries off from the global system. But every one of these privileges depends on the dollar remaining indispensable. If the digital yuan gains traction, if more trade gets settled in renminbi, if more reserves shift away from dollars, that indispensability fades. Western banks face a different challenge. The 2008 crisis led to massive new regulations through Dodd-Frank, and Basel III banks now hold more capital and face stricter borrowing limits. These are necessary safeguards, but they also mean Western banks are less competitive against Chinese state-owned banks that operate under different rules and answer to different incentives. When China's biggest banks make strategic loans to support Belt and Road projects, maximize borrowing and take risks that generated immediate profits but created systemic fragility. When the crisis hit, Western governments had to bail out private banks because letting them fail would have destroyed the entire economy. China's state-directed model avoided this trap. Chinese banks serve state objectives. If they make bad loans to infrastructure projects that don't generate commercial returns, the state absorbs the losses. This creates different problems: inefficiency, misallocation of capital, reduced innovation. But it doesn't create systemic collapse. The uncomfortable truth is that China observed how the U.S.-dominated financial system works and designed a strategy specifically to exploit its vulnerability. The system depends on everyone continuing to trust dollar-dominated assets. China saved enough dollars to give itself independence from that system. The system depends on developing countries having no alternatives to Western institutions. China built those alternatives. The system depends on control of strategic resources and supply chains. China systematically grabbed that control. This doesn't mean China's approach is better in every way. China faces huge challenges: a rapidly aging population, massive local government debt, a property sector in crisis, and the built-in inefficiencies of state-directed investment. But in the specific area of building strategic financial power while avoiding dependence on Western banks, China's strategy has been incredibly effective. The real question isn't whether China outsmarted Western banks. The evidence says yes. The real question is what happens next. Will the United States and its allies adapt by cutting deficits, rebuild industrial capacity, and creating more resilient financial systems? Or will the slow erosion of dollar dominance continue until we wake up one day to discover the rules have fundamentally changed? History suggests that transitions between dominant powers and dominant currencies are rarely smooth. They're usually accompanied by conflict, economic, political, and sometimes military. China's $6 trillion advantage didn't appear overnight. It was built over 4 decades through patient saving, strategic positioning, and learning from every Western financial crisis. The advantage is real. The question is whether the West understands it in time to respond.